All right, Brad, we're back at it.
All
By the
right.
way, who are you?
I am Brad Avon. I'm a senior loan officer with Fairway Independent Mortgage. And
Are you
Gary, who are
still
you?
independent?
I am still independent.
I'm not. I've switched firms. I've gone to my own firm, GK Group, and that allows
Fantastic.
me to be independent, but in a different way. So the logo will now say me as opposed to anybody else.
Well,
Um,
congratulations, Gary. That's good news.
Thank you. So, Brad, as you look at the market and you look at what's going on with interest rates, what are your thoughts?
So my thoughts are, well, first of all,
And
things
by
are
the way,
trending.
I'm going to let drop a dime.
Oh,
We
okay.
had recorded this the other day, and Brad made a prediction, which turned out to be right, but he was very, very nervous, kept throwing up different obstacles through the week to not publishing it until he knew he was right. Now he knows he's right. So, what are your thoughts on the interest rates?
I am glad I was right. But it's still very interesting the way things have happened. So today, as we record this, it's September 18th. The Fed yesterday dropped what's called the interbank rate, the Fed rate, which is the interest rate at which banks borrow from each other, and they dropped that by about a quarter, which what I was predicting. So I'm glad I was right. The interesting thing about that is the market had already built that quarter in, meaning the market had predicted, just based on a lot of the information that was coming out, that the Fed needed to make some sort of adjustment to their monetary policy, and they did exactly that. Some people were predicting that it was going to drop a half. Some people said they're not going to drop at all. Most people were predicting, you know what, this is a good, reasonable move, and they dropped a quarter, which is what they did. Now, the mindset is, you know what, it's good, everything's going to drop a quarter of a percent, but that's not exactly how things work. Meaning, short-term interest rates will drop. You'll probably see things like credit card rates, they may drop a bit. Equity line rates may drop a bit. Mortgage rates are more tied to long-term indices. So like 10-year Treasury bills, things like that. So those may move a little bit, but it's not lock and step. So you won't necessarily see those drop by a quarter. That being said, the important thing to note is that the Fed said, they came out and said, we're going to look at each month on a case-by-case basis. Now, the interesting thing about this is that the market has already predicted. The market thinks they know better than the Fed. The market has already predicted that the Fed is going to need to adjust 2 more times this year, and that's the number of meetings that are left. So they're basically saying, the market, whoever this market is of people that predict, they're saying that the Fed will lower another quarter, likely in October, and another quarter again in December. But I'm going to go out on a limb again, Gary. And
Oh, here we go.
I'm going to say, I don't know that we're going to see another half in reduction. We'll see. We'll see what happens, because there's a lot of things. There's a new Fed member that was just added who's considered, which is called dovish, which means they're in favor of lowering interest rates. And then on top of that, there are other people that are more what's called hawkish, which they're thinking we're going to be a little bit more conservative on interest rates. I think that realistically we'll probably see another quarter drop by the end of the year. I don't think we're going to, and we may see that in the form of an eighth next in October and another eighth, but the Fed's going to take this case by case and see where things go. And I think that is prudent. I think that's really prudent, because they want to see what's going on. And there's differing things that are happening. Some things are coming in saying that the economy is in a stronger position than it is. We just got, for example, we got a notification that the new jobless claims came out. This was today. Okay, so new jobless claims came out. So basically, what that means is people filing for unemployment, and it was forecast. My eyes are getting old here. So it came in at 231,000. It was forecast at 241. What does that mean? It means less new unemployment claims being filed. Okay, now, to put that in perspective, last month it was 264,000 unemployment. So it's dropped. So less people claiming unemployment. That's a good thing. But for the economy, but what that means is it puts less pressure on interest rates to drop. The second thing is what's called the Philadelphia Federal Money Index, and that manufacturing index. I'm sorry, and that basically was forecast to be up 1.7, and it actually went up 23.2, which is huge compared to like last month, it was down 0.3. So what does that mean? It means good news for the economy. That, if it keeps on its trend, will temper any further interest rate reductions. So that's my forecast, Gary.
What's the weather going to be this weekend, Brad?
Sunny. It's going to be sunny, Gary. Always sunny.
I like it when you do forecasts.
The good news is for clients is rates have fallen from where they were 3 months ago. We're in the low to mid sixes right now on conforming rates with good credit, good down payment. So it's a great time for people to purchase.
All right, Brad. Thank you very much.
Thank you, Gary. Talk to you soon.
Bye.